playing or maneuvering through the India market. We've got Rana B. Gupta joining in on the show right now. Rana, hi, good morning. Great to have you on the show today. Rana, I was just looking at data and the kind of outperformance that India has had month to date vis-a-vis the rest of the world. I mean, the Dow's fallen about 1%, India's fallen less than 1%. You've had NASDAQ fall about 6%, FTSE 100 down about almost 4%. And I'm not even touching upon the Asian markets. I mean, Hong Kong, for instance, has been down over 16%, or the CSI 300 about 12% or so. Rana, the cool-off that one has seen in crude, the fact that a 25 bips hike by the Fed seems to be already in the price, and the fact that we're coming out of a zone of acute selling here in India as well. Does that give you a sense that somewhere maybe India markets may have bottomed out and the worst could be behind us?
Okay, so there are quite a few issues that you touched upon. Let me touch upon that one by one. On the Nifty, I have to say the Nifty's composition is very balanced. You have the financial stocks, the IT stocks, the material commodity stocks, energy names. So Nifty is a very balanced and very in terms of sectoral split if you compare to other indices available. So I think that provides some support to the Indian markets, and that is also one of the reasons why Indian markets have done well. Crude coming off is definitely a relief. But having said that, we have to be cognizant of the challenges that is there in terms of geopolitical tension. And yes, Fed rising rates of 25 bips is perhaps priced in. But we have to watch out, though, for the continued supply disruption, whether due to COVID or whether to geopolitical tension, and what it means for inflation, particularly the second half of this year. Because the earlier view was the second half inflation numbers will come down towards normal levels, but that assumption is getting challenged by the geopolitical tension and the COVID outbreak in China and Hong Kong.
So in that light, Rana, do you tactically stay away from crude sensitives, companies which have crude as a high component of their raw material costs?
Definitely. I think what we are doing is that there are two things very clear right now. The real growth will be slower than expected, and inflation could be a little bit higher than expected. What it means for the corporate earnings. I think for the corporate earnings, the companies which have a lot of cost linked to crude and crude linked materials, they will see quite a bit of sharp jump in the input cost. Now, it depends on the companies whether they can pass it on or not. But I think the bigger point is this, that rising food and energy prices will cause real income to stagnate or maybe even decline. So how much money the consumers will have, even if the companies were to take price hikes. I think that is one point one is to keep an outlook on. So therefore, it's best to kind of position in companies where the nominal GDP growth, that should be still quite high, where nominal GDP growth helps, and where the raw material prices are not so much linked to crude.
Hi, good morning. Just looking at the kind of instances in which we've seen hectic FII selling in the past. And, when we had the COVID-19 crisis, it was close to $10 billion. And from October 21, it was close to $20 billion. As of now, well, we have seen the FII selling taper off. What do you think would really help turn the tide when it comes to the liquidity situation, while DIIs continue to remain buyers?
So I think a lot of FI selling could be attributed to the general outlook towards emerging markets, because some of the FIs could take a view that a rising US trade environment may not be so constructive. So we don't think the outflows are specific to India-driven outflows. It's a part of the emerging market allocation, or so we believe. With respect to flows returning, I think there are a few factors one needs to consider. Earlier, I mentioned about the Nifty is a well-balanced, sectoral split, quite a good of depth of good quality companies which can stand up. Their earnings can even be resilient in this kind of environment. I think if the crude drops to something like $90, that gives a lot of comfort for the foreign investors on the currency front. So I think that would be one of the trigger. And the third, and obviously one of the trigger which has been there for some time and should work in India's favor, is that most of the other emerging markets are facing one issue or the other, most of the large emerging markets, I should say, whether this is geopolitical concern, whether this is regulatory scrutiny, or whether there's some rearrangement of their indexes and so on and so forth, that makes India kind of stand out, because in India there are no policy uncertainties. There is stable political environment, stable policy environment. The rising crude and the political and the geopolitical tensions are impacting all equity markets. But I think India's resilience over the period of time, over the last 2-3 years, thanks to the domestic reforms that has happened, has improved. And I think that factor should come more to the fore for the remainder of this year.
Always a pleasure interacting with you. Many thanks for taking the time out and joining us this morning on ET Now.